beta. Okay, beta. Obrang, right? Obrang kind of things, right? This is random variable. You don't know where it's going to go. The constant gets out. Random variable remains there. Okay. Hello, how are you? Welcome to Intermediate Corporate Finance, week 6 portion of my lecture. Today, we're going to talk about something called security market line and beta using capital asset pricing model. And where are we in our lecture schedule? Here we go. So we've been talking about the discount rate that we're going to use in DCF model. Of course, discounted cash flow model, you need discount rate as well as cash flow. So for discount rate, we've been going through the cost of equity, and then the cost of equity, you first have to start with risk-free rate, and then equity risk premium, and you have to multiply it by beta. So one by one, we are covering those things, right? Next week or the week after, we're going to talk about the cost of debt and weighted average cost of capital, so wait for that one. And then we'll move down to free cash flow part. Now, discount model, discount rate models, right? Let me shrink my picture a little bit. Can you see me? Yeah. All right. So, required rate of return, okay? So we are trying to estimate the opportunity cost of capital in equity market. Why is it opportunity cost? Well, given the same risk profile, the investors could have invested in something else other than your security. They've been foregoing some opportunity over there. So that's why this is the concept of opportunity cost, right? And then always this discount rate or required rate of return starts with risk-free rate, and then we add risk premium. For example, if you are investing in Tesla, right? These days, Korean investors invest a lot in Tesla, Amazon, and all kinds of US stocks, right? Because of the globalization of the capital market. Anyway, so if you are investing in those these company, right? Tesla, you would say, well, this is just like putting my money for this investment security. As long as this security is risky, I want to get compensated more than U.S. Treasury, what U.S. Treasury is guaranteeing me, okay? So I want to get compensated better than risk-free rate. So that's why we start with risk-free rate as a rock bottom. And then we add the risk premium to get the required rate of return. And this risk premium has to be company specific. Tesla's risk premium could be this, and Apple's risk premium could be that, and then ExxonMobil's risk premium may be that. We don't know, okay? Where would it go? How would you model this risk premium for each security in a standardized way, right? So capital asset pricing model comes handy over there, right? And they say, well, for risk premium, let's start with this portfolio theory so that you form a market portfolio that has all the risky stocks and assets like crude oil or whatever, diamond, okay, real estate, everything inside. We call it what portfolio? Market portfolio, okay, market portfolio. And then for this part, right, we found how to get to that efficient portfolio, right? And then for this part, market portfolio is expected to give us some kind of premium compared to the risk-free investment. There's a risk-return trade-off, right? More risky and higher risk premium that we expect for the portfolio, market portfolio. And that premium related to this market portfolio is called market risk premium, okay, market risk premium, which is different from Tesla's risk premium. How is it different? Well, Tesla's risk premium is a multiplication of this market risk premium and Tesla's something called beta. We're going to talk about it today, okay? So, market risk premium. The capital market line we talked about yesterday or the week ago, okay? market risk premium is pretty much determined in the market, and Elon Musk, right, has no control of this market risk premium. Oh, Elon Musk, such a great guy, doesn't he have any control over market risk premium? Come on. Tesla is just one of the thousands and thousands of different stocks. How can he control, right? So that's why market risk premium is determined in the market, and the CEO of Tesla is just a price taker. Okay? Price taker, what do you mean? Market risk premium, we call it the price of risk because this is determined in the market. Nobody has control over it, but the market participant is just a taker of this. Okay? And market risk premium reflects what? The risk aversion of the average investors in the market, right? So Elon Musk has no say on that, right? He has to take that risk premium as a price taker or market risk premium taker, shall I say, right? For Tesla, what he can determine, or what Elon Musk can influence, is something called beta. How is it get controlled, right? Well, capital structure and operating leverage, fixed cost versus variable cost kind of things, and then the industry nature, that kind of things will determine it. We're going to talk more about it later on. And this is why we spend so much time on beta in academia. Once you go to the industry, they will say like, well, take the beta from Bloomberg Terminal or whatever the Naval Finance gives you. Okay, no worries. Why? They're not really interested in corporate finance, but they're more interested in investments and asset pricing over there, right? Portfolio management kind of things, right? So they don't really spend much time on beta that much, right? As long as you are portfolio managers. But for corporate finance purposes, CEOs and CFOs, so those key decision makers, and those equity analysts for in M&As, all these kind of things, right? M&A analysts, you need to spend more time on the beta. Why? Because your capital structure decisions and this kind of corporate financial decisions affect beta, not market risk premium, nor risk-free rate. Come on, you're not central banker. How could you influence the risk-free rate? Man, how dare you, man? So that's why, okay? We spend a lot of time studying beta. Okay, so I want you to make a solid understanding about this beta, all right, with me. Yeah, let's go. And capital asset pricing model is a grandpa model about analyzing this risk premium, okay? Why is it grandpa model, and then why did it get Nobel Prize of Economics, right? Harry Markowitz and William Sharpe and Lindner, right? Why did they get the Nobel Prize? Well, because it is such a simple model that explains the risk premium, okay? They come up with, right, they start with market portfolio, okay, portfolio theory, and then they propose one single factor that explains everything, okay? So very simple, very attractive. One simple factor, what do you mean? Well, market risk factor. They say you don't have to worry about anything else. All you need to worry about is just market risk, okay? How much of a market risk does your company, Tesla, have, okay? And how sensitive is it moving, okay, to, how sensitive is it moving to, together with market portfolio, okay? That is the only thing that you have to worry about. That's a systematic risk. And to the extent that Tesla moves away from the unrelated with the market, right? Because maybe the firm-specific factor, for example, oh, Elon Musk is such a good-looking guy, or Elon Musk is a, low voice pitch that is sexy, maybe to some people, maybe driving their stock price in a certain direction. Okay, and believe me, there is a behavioral finance research about CEOs attractive looking, right? Halford and Sue's paper recently talked about it. And then they go for this CEO's, facial beauty measure. And then quantitatively measure it. And then they find that good-looking CEOs or sexy-looking CEOs, their stock price is higher than comparable companies, okay? That kind of idiosyncratic factors are not compensated, okay? According to capital asset pricing model, right? Idiosyncratic risk factor, for example, okay, the appearances. Well, why is that the case? Because in capital asset pricing model, you start with this market portfolio setting so that you take the perspective of these diversified portfolio managers who have thousands of different stocks, okay? So that Tesla is not the only one, but somebody else, some other stock is also there within his portfolio. So much so that when something bad happens to Tesla for its own unique factor, for example, Elon Musk farted on the CNBC interview, maybe, which doesn't seem like a good news. Maybe he has stomachache, and maybe it's a symptom of bad health. Maybe I'm making some kind of fictitious situation, but that's firm-specific news, right? Oh, Elon Musk farted. And then digestion problem, maybe. That may be bad news for Tesla, but it may be good news for its competitors, right? So that competitor stock within my portfolio will go up, okay, canceling out the Tesla's negative effect, right? So I don't need to worry about this idiosyncratic or firm-specific risk. All I need to care about is the degree, how much the Tesla moves together with this macro shock of market risk, right? How sensitively is it moving? And so much so that it makes my market portfolio riskier than the situation of not having this guy. Make sense? Right? If this Tesla is going to make my market portfolio riskier, I'm going to punish this guy more, and I'm going to require more risk premium. Okay? That's the idea. To the extent that this one does not affect my market portfolio to be more risky or less risky, it doesn't move together that much, I don't care. Okay? That's fine. That's the idea. So capital asset pricing model, Nobel Prize winning because it's one factor model that I said. Very simple. If it is like a 조폭 movie or like a gangster Yakuza movie, it's like a boss, the Yakuza boss kind of guys, right? In the movie. What are their characteristics? Okay? The bosses, they don't do like, all kinds of like complicated technique there over there, okay? Fighting technique. Their technique is very simple. One punch and kill everybody else, okay? One punch, one shot, like 이뽕 in terminology over there, right? Gangster movie terminology, let's say, right? 이뽕. 이뽕 of what? That market risk factor. So that's why it was going far, far away, like, getting the Nobel Prize. Later, 30 years down the road until now, people in academia and the hedge funds, they have been developing this model further and then found out, oh, there are some other systematic risk factor. Okay, remember in CAPM, systematic risk was supposed to be compensated by forming portfolio. Idiosyncratic risk, no. Okay, systematic risk, market risk was the only systematic risk in CAPM. Make sense? Later, people found out that, the systematic risk, was that the market risk is one of the many possible systematic risk. Okay? It's just one special case. CAPM was one special case. More generalized model gets developed these days, so that there are a lot of systematic risk factors that are independent of each other, hopefully, because we are constantly investigating whether they are really independent of each other. For example, size factor, book to market factor, and momentum factors, and reversal, short run or long run reversal factors, all these kind of things, right? Found out to be systematic. And interesting thing is, these factors, size of the company, book to market of the company, and momentum, these are not explained by market risk factor. Okay, that is what the finance PhD guys are working on. Okay, in investment or asset pricing side. Of course, I'm finance PhD as well, but I'm more to corporate finance side rather than asset pricing side. For this kind of multi-factor model called Pharma French 3 factors, 4 factors models, right? Or n different factors, right? If you're interested in those things, go ahead and study intermediate investment class, right? It's going to be a lot of fun over there. Of course, also behavioral finance and fintech, my class later on in the fall semester, we also cover that part, right? So that's something waiting for you. But for almost all of this class, right, throughout the semester, we're going to focus on capital asset pricing model. Boom, right? Let's go. And then, remember last time we said the notation or notion of a benchmark, right, has to be like this. The two basic questions that every risk and return model in finance tries to answer are, one, how to measure risk, and two, how do you translate this risk measure into expected risk return and then risk return premium or risk premium. Okay, remember the total risk kind of things, right? That was like a standard deviation unit, or variance does not even have a unit, by the way. Variance, right? Standard deviation is less problematic because it is percentage figure, but you know, volatility, how to measure it and how to translate it into percentage figure of return premium or risk premium, shall I say, right? As a big question. And a good risk and return model should do the following. One, it should come up with a measure of risk that applies to all assets, not just one specific asset. And number two, it should clearly describe what types of risk are rewarded and what are not. And it should provide a rationale for the delineation. Systematic risk versus idiosyncratic risk. We delineate this thing, right? And then we should come up with a standardized risk measure, okay? I.e. an investor presented with a risk measure for an individual asset should be able to draw a conclusion about whether the asset is above average risk or below average risk, so that you can take some relative positions of long-short portfolio, okay? It should translate the measure of risk into a rate of return that the investor should demand as a compensation for bearing that risk. Now, number 5, lastly, it should work well not only at the explaining past returns, but also in predicting future returns as well. Out of sample forecasting capability, okay? It has to have that. All right. So in that sense, we learned about this capital market line. Okay, just a minute. Let me. Okay. Capital market line. This is a refresher. Do you remember that? Capital market line. What was that about? Well, as you see in this line over here, okay, capital market line, which is FAQ of CFA exam, all right? And so I'm going to ask you this question in your midterm exam or quiz or final exam, no matter what, right? I want you to remember throughout your life, capital market line. This is about the risk and return relation for the portfolio level, okay, portfolio level. And then how is this expected return over portfolio is related to the total risk of the portfolio, right? So we formed market portfolio that is composed of all different risky securities, right? Risky securities, and we constructed the efficient frontier using this risky asset, okay? And then we had two fund theorem. One of the funds in your portfolio has to be risk-free asset. The other fund is your market portfolio, or the portfolio that has all the risky assets, right? Not risk-free assets. So you have two different kind of funds in your portfolio, okay? And your portfolio has to be constructed based on these two, risk-free asset and risky asset represented by market portfolio, right? And then you can form a straight line, okay, straight line, and then you can form a portfolio on this straight line that is called capital market line, capital market line. How do you come up with this formula or the equation of capital market line, okay? Now, notice this one, okay, by the way, capital market line. I'm going to talk about something called the security market line, which is going to be awfully confusing to you, okay? So wait for that one. But capital market line, what is on your horizontal axis? That is portfolio risk, right? Portfolio risk. Let me expand my picture. Yes, like this. Like this. All right. So, and then your vertical axis, that is expected return of your portfolio. This is a portfolio level, okay, argument, right? Total risk of your portfolio, okay? This will be important later on. This is superficial, but still important. Now, this is 0, okay? And market portfolio, based on your risky assets, somewhere it will be, okay? This is the minimum variance portfolio, which is has the lowest level of, this is minimum variance portfolio, right? Minimum variance. Why? All the risky asset portfolio will be on the right-hand side of this, okay? Minimum variance, minimum risk among these risky securities, right? You can think about it but the important thing is your efficient frontier will be this curve over here, okay? Now what you introduce? Risk-free asset, okay? Risk-free asset, which is U.S. Treasury, of course, over here I would say, right? Now we labeled it as RF, okay? By definition, risk-free asset has no volatility, guaranteed payoff to you, right? That's why. Now, what do? Well, draw a straight line, because you will be able to form portfolios upon this straight line that goes through this risk-free asset and that touches upon or tangent to, right? Tangent to 접점 in Korean terminology. In this efficient frontier, we call it market portfolio. Make sense? So your portfolio, well, what does this capital market line tell me? What does the capital market line tell me? Is that, well, the portfolio manager says to you, okay, you tell me your desired level of expected return for your investments, okay? I can form a portfolio that satisfies your need. Okay, I can construct a portfolio to meet your demand. Okay, you call me your desired return level, expected return level. I'll give you how to construct a portfolio based on these two assets, risk-free asset and market portfolio. How? Well, let's say your desired expected return level is something over here in our diagram. Yeah, it's something in the C, for example. Okay. Oh, I want this level of return. I don't know how much, right? But the manager would say what? Well, if that is the level that you desire, okay, if that is the level that you desire as a return, the portfolio that I can construct should be this one, okay? So the weight on the risk-free asset will be this relative to the total 100% level, okay? The weight on the risk-free asset will be this, and then the weight on the market portfolio will be the remaining part upon this line, right? So I'm going to call it W, and then this one 1 minus W, so that the portfolio weight sums up to be 1. Make sense? Right. Put another way, okay, saying it again, okay? Portfolio manager asks you, okay, how much of a risk return level do you want to achieve, okay? What's your desired level of expected return? And I say, well, something like 50% expected return over the next year. Oh my God, that's very high, right? Even though the market portfolio's expected return may be like 35%, you want 50%. How would you achieve that? Well, the portfolio manager says, don't worry, I'm going to construct a portfolio for you, which is leveraged position portfolio, which is, let's say, this and over here, okay? Right? And then the return level that you want, well, you have to sacrifice something. High risk, high return, okay? To the extent that you undergo this kind of market risk and then leverage it out, you can get compensated, okay, in an expected return manner. It's not a guaranteed return, but with some randomness over there, okay? The systematic part will be compensated. Nice, right? The problem may be, oh, wait a minute, wait. This one is my market portfolio anyway. This is my risk-free portfolio anyway. How do you achieve this level? Then what is happening? Risk-free borrowing is happening. Leveraged position, because to go here, you borrow money. Okay, you borrow money risk-free, so much so that at the end of 1 year, you have to repay it. Your cash outflow happens later on. Okay, and then the weight on your risky asset will be bigger than 1. Okay, weight here, the weight of your risky asset will be bigger than 1. And then risk-free assets, weight will be still 1 minus W. Okay, RF and then RM. Okay? If this guy is bigger than 1, then this guy will be smaller than 0. Make sense? Negative weight. That means negative weight. That means borrowing. Okay, borrowing. Right? That's what's happening. Right? That's what's happening over here. So that's capital market line. Capital market line. Interesting, right? Give me the desired level of return. I'm going to give you the risk level that you have to undergo. Okay, higher risk, high return, low risk, low return. So depending on your risk preference, everybody can line up. Oh, I'm a risk-averse guy, like a I don't know, grandpa. Okay, I want something safer. Line up over there. I'm a young blood. I want to, go for more risk and then achieve more higher return. They go for leveraged position. Okay, borrow money and then put everything into stock market or something crazy, which I don't really suggest to you, but there are some guys doing it. Okay, so depending on your risk preference, everybody is sharing those risks on this line. Nice, right? So that's why it got Nobel Prize. Now, one thing is that what we want, okay, a model of expected return of a security in the market portfolio, okay, Here it's about market portfolio and then forming up portfolios based on risk-free asset and then market portfolio. But what we are really want to get at is not this portfolio itself, but the component stock, all right, component asset. So capital market line is close but not there yet. Okay, so security level, Tesla Motors, okay, should be inside here, but it's just one of them. How do we get there? Okay, and then estimate the cost of equity for Tesla. Okay, can you find me some connection from here to there? Now, let's start from capital market line. Okay, capital market line. Here we go. Yes. Right. The equation. This is the one I wanted to tell you in the beginning of, right? This picture. So this is just high school math, right? 2 points and the straight line that connects these two, right? That's that simple? Yeah, that's simple, man. What more do you want? Finance is always utterly simple. So much so that many people say, no, there must be some black magic going on. No, this is no black magic. Black magic goes on in your accounting class. Really? Yeah. Okay, fine. 2 points. Straight line. What's the equation? High school math. Well, this is our, wait, 0 here. This is 0, RF, XY plot, right? And this one is what? The DTT, should I say? Right. And then the expected return on the market, right? Whether you use it big M or small m, I don't care. Okay? Over here, so based on these 2 points, how do you get the equation? Well, what is that? Your y minus that RF should be equal to what's that? Rise over run. Okay, rise over run. That is this guy, expected return on the market, minus RF, that guy, right? Over run. So from this one, 0 to sigma m, so that's this guy. And then x minus 0. Make sense? Yeah. Can you see it? Right. There you see it. So the thing is, here we just want x and y to be what? I would say the expected return of your portfolio. This is because portfolio level argument, right? Remember, not a security level argument, portfolio level. And this one should be the total risk of your portfolio. Again, this is portfolio level argument, capital market line, right? So you do the arithmetic, okay, and then cancels out. And this one, take it, send it to the other side of the equation. So you get ERP equals RF plus ERM minus RF over sigma M of sigma P. Make sense? Types. And that's capital market line equation. Nice. Another thing to notice is the slope term. What did I say this is? This is called Sharpe Ratio. Okay, Sharpe Ratio. The intuition is the excess return. Okay, excess return against the risk-free return, right? The excess return of your portfolio strategy for each unit of risk. So for each unit of risk that you take in this portfolio strategy, market portfolio, okay? So you want to achieve more efficiency in your portfolio strategy, you want higher Sharpe ratio. The tiltedness, okay? Over here is Sharpe ratio, okay? a higher Sharpe ratio you prefer. Okay, why? Because for a given level of risk that you desire, you just have to take less risk. Make sense? Quite intuitive. Now that's that. Okay, that's that. The equation of capital market line. It's just a starting point. It's just the starting point. So what do we want? All right, let's go. Right. The portfolio we are interested in is market portfolio. Okay, in equilibrium, market equilibrium, that we achieve the most efficiency, right, in achieving the desired level of risk, the market portfolio at that level, right? How can we play the mathematics so that we could go into the intuition about each different security? Oh, here we go. Okay, so the expected return of the market portfolio. Okay, we start there, right? Using this capital market line formula, we do mathematical manipulation. Okay, mathematicians' favorite technology is we have two things. One is multiply by 1 and bring something interesting and then replace this 1 with something interesting formula. Okay, and then another mathematician's favorite technology is multiply and divide by the same number. Okay, so for that purpose, we bring in those standard deviation of return or market portfolios risk, market risk. Okay, sigma m, right over there. You will see why we need this. Okay, and for 1, right, that we brought in over here, let's say, here's the reason why. You know, this portfolio that we introduced, right, is this market portfolio, okay, the portfolio that we are interested in. But instead of using the notation of M for this portfolio, we are just using P, right? And as it turns out, this is identical portfolio, so much so that the correlation between these two guys will be 1. They are identical, the same one. So that's why we bring in over here 1, and then we are going to replace, stick in this guy. Okay, and number 2, we bring in sigma m. Okay, why? Well, by the way, first thing first, let's bring in the correlation coefficient, right? Correlation coefficient, what is the intuition over there? This is showing the degree of linearity of these two random variables, right? How are they moving together in a linear fashion? 1 means like they are perfectly correlated. Okay, perfectly correlated. -1 means they are perfectly negatively correlated. Whatever you gain, I lose. But 1 means whatever you move, I move together. Okay, identical twin kind of things. All right, fine. So it becomes this formula over here, equation. And then risk-free rate, that's the same thing. Sharpe ratio changed into something ugly over here. What the heck is that? Well, because we brought these two. Why do we need it? You will see it later. And then over here we have standard deviation of portfolio return and then standard deviation of market portfolio return, which is going to be the same, but we're going to expand it later. Then the next line, what we see, the same thing, but the numerator is kept over here, right? Denominator, where are you? This guy, go over there. Okay, it's a multiplication over here, right? The same multiplication is, so it doesn't matter. They're the same thing. We didn't change anything, but this one shows up. Where did this guy show up? How could this happen? Well, this one is called covariance. Covariance of two random variables, portfolio return and market portfolio return. All right, 중앙일보 속보. Yeah, it's going to be history anyway. And 중앙일보 속보 keeps on coming up. Come on. Yeah, we have another one coming up, pops up. I hope nothing embarrassing comes up later on. Please be silent. Oh no, come on. I'm in trouble. Yeah. We're gonna get back to yeah, like this. All right, thank God it's not, you know, any embarrassing sight. Anyway, so that's how we bring in this covariance. The covariance is, what's that? Covariance of two random variables decomposed into three things. One is a correlation coefficient of these two random variables. Two, or the remaining two, are those standard deviations of these two random variables, right? That's what's exactly happening over here, right? Good. Then what happens? Well, it becomes like this. The same thing, and then this one goes down, and this ugly term over here, covariance over variance, is called something called beta. Okay, beta. That's the first encounter in our class, the beta. And here, again, we're still talking about the portfolio level. So this beta will be portfolio beta. Still not Tesla's beta yet. Okay, still not a Tesla's beta, but the portfolio beta. Okay, we just introduced a terminology called beta. We're going to talk more about the regression and sensitivity kind of ideas later on, so wait for that one. Okay, so we have portfolio level equation. Okay, we just replaced the capital market line equation into some equation that involves beta. Okay, and this beta, because this is a beta over portfolio, we can imagine a situation where you have only one portfolio or one security in your portfolio. One security in your portfolio, very, 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 very special case, but we can just extend our ideas, right? Much more mathematically involved part will be there. But if you replace the portfolio with one single security called I, then it becomes the last equation over here. Your security's expected return should be equal to risk-free rate plus market risk premium times its beta, the security's beta, or Tesla's beta, not the portfolio beta this time, okay? Because you replace the portfolio with just one single security, okay? So this is the equation of security market line. Why not capital market line? Capital market line was about portfolio level discussion. Here it's about security level discussion. One single stock, one single stock, one single stock. Okay, so that's security market line. We're going to talk about it a lot more in detail. Now, in case you want, in case you like mathematical derivations of this, right? The following one slide is there for you. It's not going to be tested in the exam. The following slide, okay? But let's go through just once in your lifetime, okay? Yeah, right. And given that a lot of you want to do some double major in engineering, okay, this would be fun exercise, right? Start from this portfolio level equation with the beta notation over there, beta of the portfolio. Let's say the portfolio has n securities with weight of W1 all the way down to Wn for n different securities, right? And then by definition, the portfolio weight has to sum up to be 1. Unity, right? United we stand, divided we fall. The unity of 1, okay? 모여서 하나가 된다. It's the same idea, okay? 동서양이 똑같아요, right? Anyway, so if you introduce this idea to portfolio, the P over there, okay? You're going to see that this equation switches into this one over here. Expected return of your portfolio should be nothing but the weighted average return of each different securities. Make sense? Yeah, that's the first equation. And the second one, yeah, is that the weight, okay, is a constant, whereas the returns are random variables. For example, I should have said this, tilde and tilde, 꼬부랑, right? 꼬부랑 kind of things, right? This is random variable. You don't know where it's going to go. but the weight should be a constant until the end of the day, until the end of the year. You hold it, freeze, goes on. Okay, it's different from random variables, right? So that's what's going on over here. Now I claim that it's going to be the same as this one, because risk-free rate, okay, well, it's going to be the same as this and that. And the risk-free rate, you start it, it stays there, but it's nothing but multiplied by 1, which is the same as the summation of all the portfolio weight. Make sense? Okay, fine. The market risk premium stays the same. That's good. The only thing that we have to worry about is portfolio beta. And I claim that the portfolio beta will be what? The weighted average betas of the component stacks. Oh my God, weighted average betas. You didn't even talk about the beta yet, but how could you do that, right? Well, we defined it in a brief manner that the beta is nothing but the covariance over variance. And we are using the trait of this property of this covariance, which is just a linear combination of the random variables, right? It gets back to your statistics 101, right? You have to master this thing no matter what, okay? Even if you don't want to major in finance, right? Because machine learning and all these things, even in marketing, you have to use this one. So let's go, okay? 피할 수 없으면 즐겨라, right? If you cannot avoid it, enjoy it. So let's go. So this is it. Now, because weight, yeah, I told you about this part, and the second part is explained by this yellow box. So portfolio beta should be nothing but the covariance over variance. The covariance, what? Of portfolio return and market return. And then the variance part is important because it has to be market return variance, not portfolio return variance, right? So the market return variance has to be there. So keep it over there. We're not going to touch on this one. And the second term, market return, this random variable, just keep it over there, right? We're not going to play with this one. The only thing that we're going to play with is this portfolio return random variable. I said comma over here, comma, okay? And this portfolio return, as I said before, that is the weighted average of component stacks returns, okay? And you expand it, and this one, weight, is a random variable or a frozen one? Freeze. This is a constant. It freezes. Doesn't move, right? Until you finish the next period, right? The same for the rest of WNs, right? Random variables are these R's, right? These R's, they are wiggly moving from one way to the other, right? So that's good. What are we going to do? The property of covariance, right? Property of covariance says, well, plus. If it is a linear combination of random variables, you can split into separate covariance like this, and then one random variable is covariance with the RM, should be a separate one, covariance. And then the second property, whatever there is not random variable, if it is a constant, you can take it out, right? Over here, right? And then like this. So what does it become? Well, all of this bunch of things become a bunch of covariances over variance, okay? That will be represented by beta. Beta 1, beta 2, beta 3, and beta n. Make sense? So we switch everything into beta, and then weight remains over there. So what's the consequence? Well, it becomes a linear combination of betas all the way down. Now, what do we want to do? Well, if you do the arithmetic over here, right? If you do the algebra, okay, it's going to be a linear combination of, the left-hand side will be a linear combination of or weighted average of expected return on each different securities, like this, because of the property of expected values, right? The constant gets out, random variable remains there, okay? And then, what about the risk-free rate? Well, we can interpret it this way, as we said it like this, right? And the thing is, weight of 1, 2, 3, 4, 5, 6, 7 until n, those things we can gather together like terms. So W1 is there, and that is multiplied to RF as well as this whole bunch, because we have over here and then this guy. So take this guy out for 1, and then it becomes 1. And then for n, it's the same thing. This one, and then weight of n. So that becomes this, and the remaining part will be this. Okay? So what do we see? Well, it's going to be a linear, how do you say, summation of weight of the security and its expected return equals the summation of weight of those securities and this ugly term over there. Okay? So this should hold for any possible weight and any possible portfolios. Okay? So to that, okay, for that to be achieved, one thing you have to, one thing that should hold is for any I expected return has to be the same as RF plus this whole ugly term over there. Okay? So it's kind of a loose derivation of a security market line. I'll admit that, right? But so this is basically what we can come up, right, to explain the connection between the capital market line to the security market line. The capital market line, based on this market portfolio over here, right? And then component securities over there. As long as the market is in equilibrium, the security market line also holds true like this for each component of the stocks. Okay, so that's the intuition, the mathematics going on. Let's go to the next page, okay? Right. In case you don't like mathematical approach, here is my introduction of security market line in very verbal way. I hope you like it. Starting from capital market line, how about the risk of individual security in that market portfolio in equilibrium, right? Good. Now, that leads me to the next slide. Let's define R sub I. It's not minus, it's just a bullet point over there. I should not confuse you. It's just a bullet point, okay? So R sub I, return of stock I, and RM, return of market portfolio, market risk premium, RM minus RF. Whether you use it expected return ERM or not, I don't care. So RM should be RF plus market risk premium. That makes sense, right? That was the definition of market risk premium. Excess return of market portfolio in excess of what? In excess of risk-free security. That's market risk premium. All right. So required rate of return for security I should be risk-free rate plus risk premium of I. Same intuition. Okay, risk premium of I instead of market risk premium. And then what we want to express risk premium of I, Tesla, in a certain standardized way, so that when I equals M, RM should be equal to RF plus 1 times market risk premium. Should hold, okay, in a standardized way. Notice that the requirement for our risk return model has to be something standardizable, right? Let's say the risk premium of I is equal to something mysterious, sub I times this guy, market risk premium. And let's call this beta, okay? Let's call this beta. So that's the idea now. Go there. Now, the risk of an individual asset, okay? The essence is that the risk of any asset is the risk that it adds to the market portfolio. adds to the market portfolio. What the heck are you talking about? Well, statistically, this risk can be measured by how much an asset moves with the market, called covariance, right? Beta I should have covariance in it. Beta I of your stock has to have covariance in it, but that's not the end. Why? Because we need some standardized measure. The measure beta is in this sense, beta is a standardized measure of this covariance, right? Obtained by dividing the covariance of any asset with the market by the variance of the market. It is a measure of the non-diversifiable risk, okay, for any asset that can be measured by the covariance of its returns with returns on the market index, which is defined to be the asset's beta, okay? Beta sub I should have variance of Rm as the denominator. The variance doesn't look like the same, but the variance is exactly what, can you see it, right? Variance of Rm is this. It's the same as what I said, right? Variance, whether you represent it this way or that way, it does not matter. It's the same thing. Now, so that's that. Right, covariance over variance, right? All in all, beta I should be covariance over variance, and then covariance has to be Ri and Rm, okay? When I equals M, okay, when I equals M, then beta I should be beta M, just simple mathematical replacement of it, all right? And then beta of M, how would it be? The covariance of Rm on itself, which is variance, right? So that's why covariance of itself, right? That's the variance, right? And cancel each other out, so much so that it will be 1. So the important thing over here is that the beta of a market portfolio has to be, by definition, it has to be what? 1. I'm going to ask you this question in your exam, so you have to make sure you check this one. All right, so market portfolio beta has to be 1. And then the other securities or component securities beta, right, will be clustered around this 1. Something will be bigger than 1, something will be smaller than 1. Okay, notice it's not 0, okay, it's 1, right? Get ready for that question. Now, the risk, right, here, right, risk of an individual asset. The result, the required return on an investment, will be a linear function of its beta market risk. Okay, Ri should be equal to Rf plus beta I, Rm minus Rf. Seemingly, the formula above may not look like a linear function of beta because our usual habit of writing y equals a plus x, and then the coefficient was always on the left-hand side of the x. And you are talking about the right-hand side of the beta. So let's rearrange this thing, okay? So much so that Ri equals Rf plus Rm minus Rf times beta, okay? Finally, this one Rm minus Rf looks a lot like a slope term if we try to plot the linear relation between systematic risk, beta I should have said systematic risk, because we are not talking about the total risk. Systematic. My God. Systematic risk. Jesus Christ. The other day, we had a conference call with other department professors, and then believe me, the 한문 department, 한문학과, right, 교수님 told us that the Chinese calligraphy kind of, Chinese culture, and they have a problem about doing, writing Hanja using this mouse, right? How can you write this complicated. For example, my hanja, right? Oh my God, it's getting so ugly. So they have to do it for their testing. Oh my God. So is there any way? Other departments are even more trouble than business department or global business. So please bear with me, okay? Anyway, systematic risk, beta, and RI, return, and the straight line that shows the risk-return trade-off is called security market line. I call it SML, all right? SML. What's the difference between this capital market line and security market line? Again, capital market line was about the portfolio level risk-return trade-off, total risk, and expected return of the portfolio. Security market line gets to that security level instead of portfolio level, and then it's about the systematic risk measured by beta, not the standard deviation of return. Notice that. I'm going to ask you this question in your exam, okay? Beta, okay, of a security, not necessarily the portfolio, okay? But component security. Of course, later on, you can think about beta of a portfolio. There are different kinds of portfolio, but in security market line, you can plot it over there. But what I'm trying to say is the systematic risk part represented by beta instead of standard deviation. That's the thing over here. And horizontal line was that. The vertical line is the same thing, expected return, but it has to be about the security, one stack, okay? Each different security. And then here, that's what? When it is risk-free, okay? By definition, U.S. Treasury or AAA bond, right? This kind of guaranteed security. Their beta should be 0, right? So that should be plotted somewhere over here. And then this one has to be R, what? R, F. Make sense? And when beta equals 1, okay? Beta equals 1, what is it? What is it? That should be, the expected return should be ER and market portfolio's expected return. Make sense? Yeah, that's that, right? And then the important thing is, what is this slope term? What is this slope term? And if we, for that answer, if we go back over here one slide, you realize that the slope term should be RM minus RF as you see down here, okay? So if you go down to the next slide, come on, right, this slope term, rise over run, this one has to be your market risk premium, RM minus RF, right? Yeah, market risk premium. I told you before that market risk premium is proportional to, or is a function of what? The risk aversion of the investors. Okay, this is the best way to impress your economics professor. Okay, market risk premium is a function of investors' risk aversion. Risk averse, more risk averse, higher risk premium. That means the security market line's slope will be what? Steeper. Okay, so compared to before, right? Compared to 2019, what can you say about the security market line's slope as of today, 2020, especially March and April, right? Would this security market line be tilted upwards or downwards? Not downwards, but less steep, okay? 1 or 2. If this is 2019's SML, S, 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 N, M, 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 SML, right? Which one, 1 or 2, should be the SML of 2020? It should be 1, right? Because it's a spooky market, right? Very scary. Nobody wants to do business. Who wants to be an entrepreneur these days, right? Start your business? Maybe later, you would say it, okay? Very scary market. I want some more compensation because it's extremely risky. No way, okay? So that's going to be this one, market crash, okay? On the other hand, during the market bubble of, let's say, 1999 or 2006, right? When the investors in the market were going crazy about, oh, I want to put my money into the stock market or real estate. Okay, for example, Gangnam 부동산, or the real estate in Gangnam area in Korea. Okay, holy cow, holy crazy bubble goes on. There, okay, if it is the only investment that we have in the market, the security market line would be less steep, like 2, right? Investors are more willing to jump in to the bandwagon. That's the intuition. And this security market line should be a living thing that should be moving, okay? All right. So but by the way, why did I seesaw this thing, the security market line, upward and more tilted, less tilted, holding this risk-free rate over there? Well, I was assuming the risk-free rate being stuck over there, okay? Of course, this is oversimplification, okay? When the market gets busted or crashed like this situation, what happened? Like last month, you saw that in March 15th, exactly 2 weeks ago, okay? Or by the time you watch this video, it's going to be like 1 month ago, March 15th. What did Jerome Powell announce? He announced that Fed funds target rate. I'm going to ask you this question, right, in your exam and the quiz, right? Jerome Powell announced that the target Fed funds rate should be lowered down to 0, which means your risk-free rate will be lowered down to, converging to 0, quite close to 0. That means your security market line will be going down, okay? In what fashion? Risk-free rate going down, the remaining line should stay the tiltedness, typically we don't touch it, but it should be parallel moving, okay? The impact of the announcement on the market, with security market line, in and of itself has to be parallel shifting, okay? By definition. That's number 1 change, okay? The first order change. And then together with it, what do we see? The market is a living thing, and then all dynamical things happening together with it. Why did he announce such thing of lowering down the risk-free rate? Because it is a spooky market in the first place. The market is crashing. By crashing and in the risky situation, which means your risk aversion happened already, risk aversion increased already, right? That means your, what is that? There's number 2 effect also going on, okay? That is going together with it, right? Already by this time, wait. This should be happening, right? Number 1, and the parallel shifting, and number 2, the tilted slope has to be more tilted together, happening together, right? So that's the intuition about this security market line. Number 3 argument, okay, or the third part that I should not forget, okay, when we talk about security market line. Well, there are some securities, okay, whose beta is lower than 1 and whose beta is bigger than 1. And there are some securities whose beta is exactly 1, and there are some securities whose beta is negative, even negative, okay? But they will all line up over here. as long as market is in equilibrium, as you saw on the capital market line over there, right? As long as the market is in equilibrium, right? Those securities with certain level of beta should all line up on the security market line, okay? And this equilibrium, we have an assumption that the market is efficient, reflecting the true value, all the true, and reflecting the information about the intrinsic value very correctly, right? Then everything has to line up on this security market line nicely. All right, so beta, right? In capital asset pricing model, or CAPM, right? This is the ultimate measure of market risk of each security, all right? Now, we introduced the beta as a covariance over variance, right? And then we already told you that it is coming from the concept of regression, linear regression. And to obtain this beta of each security, okay, there are two different ways of doing it actually, okay. First is running regressions based on historical data of stock returns and index returns. The other approach is something called bottom-up beta. Okay, bottom-up beta using Hamada equation. What do you mean? Okay, what do you mean? You know, the conceptual issue of beta is that we are trying to estimate the covariance of your security with respect to market portfolio in equilibrium, right? And we want to use this as an estimate going into the future, usable and into the future. We are trying to get the sensitivity of the security to market-wide shock going into the future. Why not the past? Because all the investment that we do today is related to future. So I want to get a good idea of what's going to happen in the future, and depending on that, I want to establish the discount rate. Okay, for that purpose, we need to have some idea about how this security will be varying sensitively together with this market portfolio going into the future. Now the question is, how can you best estimate this sensitivity or co-movement with the market for Tesla, for Hyundai Motor, or Samsung Electronics, right? Going into the future. The thing is, we don't have crystal ball that we can, precisely tell, oh, this is how much you will be fluctuating together with the market or not. No, we don't have that kind of things, right? We are all blind kind of things, right? So we are just estimating, okay? For that purpose, we have two ways to estimate it. One way of estimating is using historical data. That is called the regression approach. So that's why we have regression beta over here. I'm going to talk about this one, okay, first. And then the following week, perhaps, we are going to talk about something called bottom-up beta, which is an alternative approach. Alternative approach is that, like, yeah, you get a good sense of, first of all, regression beta is about the history. This is what happened in the past, right? In the past situation, past environment. Now we have a shock, right? Comet hit the ground. And then before this comet hitting, it was like dinosaurs period. And after this is Ice Age. So whatever happened in this dinosaurs period, can we expect the same thing to happen in the Ice Age? Can we expect the Tyrannosaurus or T-Rex to rule the world in the Ice Age? No. Are we talking about something that we are experiencing right now? Perhaps. Okay, so regression beta. Okay, we have a strong assumption when we use regression beta to use it to estimate the cost of capital going into the future. Is our future going to be the same as our past? Assuming it is the same, regression beta, okay, fine. But if not, we have to think about it, okay? And then bottom-up beta, okay? Bottom-up beta. Oh, before we move on further, right? I told you about this T-Rex versus T-Rex age versus ice age kind of things, right? But moreover, one more thing, sometimes the company changes its character. Previously, I was T-Rex, and now I want to change into octopus somehow. Okay. The risk level, would it be the same? Even though the weather or climate is the same, you will get exposed to different environment. Like the EU is switched the industry somehow, right? And then your previous beta, your historical data, would be least informative about the future in predicting what's going to happen to you in terms of market risk or whatever. So regression beta cannot be helpful in that setting if your company changes your character. Okay, we're going to talk about it, and then this is why we need an alternative approach called bottom-up beta. Okay, using Hamada equation. So wait for that part. What kind of character are we talking about, right? Capital structure or industry character, that kind of things will be discussed. And then once we talk about this, discuss the bottom-up beta approach, well, how about when you have multiple divisions, right? For example, one of your division is going to be octopus division. Another division will be like a flying birds division, okay? All different kinds of animals within your company. And then the risk profile may be a weighted average of these things, right? So, weighted average of bottom-up betas. That's going to happen to you, okay? So wait for that. All right. Before we move on to obtaining or estimating beta using something called characteristic line of your company, okay? I tell you here, this is three kinds of lines, three lines, okay, that we discuss in this class will always be awfully confusing to you. First line was capital market line, portfolio level, total risk, and portfolios expected return. Second is security market line, okay? In security level, systematic risk, beta, and then that securities expected return, right? Number three is regression line. Wow, so many lines, lah. So confusing, lah. Regression line. To estimate this beta, okay? So confusing. And that is why so many questions are asked in the exams over here. Now, memorizing works in the short run, for example, in your CFA exams and things like that, but you will forget after the exams very quickly. But I want you to remember these things for longer period of your life, right? So that it will be helpful for you. Now, for that part, we need to go through this characteristic line, okay? How to estimate beta using the historical stock return data is something we're going to talk about from now on, okay? Before we move on further, let me take you to the actual beta in the current market right now. So I'm going to take you to my finance webpage, which is finance.naver.com. For non-Korean readers, I'm sorry about it. You can go for Yahoo Finance, finance.yahoo.com, okay? Or you can go to something called finance.google.com. All right, there you can get some beta information about the companies that you're interested in. For example, okay, let me take this here, Yahoo Finance. All right, how is the stock market doing today in the US? S&P 500, 0.01% minus. Is that something surprising? What did I say before? One standard deviation of index return in US is like what, 1.5 percentage point, right? So 0.14% to 1%, who cares? Yeah. Dow Jones, NASDAQ, and Russell, and crude oil. Holy cow, crude oil is something going on over there. But the stock market, it's like, yeah, who cares? Crude oil and gold. Gold 2% up, but crude oil market these days is going crazy. The Saudi Arabia and Russia, this is not a stock, so it's one of the important commodities, right? That you want to pay attention in the future. This one, crude oil, has direct, implication to the macroeconomy, right? So it's going to be important in your career later on if you become an oil trader, okay? In Singapore, right? Those Korean Singaporean guys, right? Among those Korean Singaporean guys, the richest guys are typically the oil traders, right? And some of them actually met us, right, in our career tour to Singapore, right? In GPR, oil trading company, 조도찬 전무님, right? And then they spent precious time talking about their industry, okay? So if you're interested, okay, working in this kind of companies in the future, maybe you will pay attention to this crude oil. But if we click it, let's see crude oil price, how it's been doing. Okay, $22, and it's up about 8.67% today. Holy cow. And then if we go to 5 years or 10 years price chart, it used to be like $70 range, and it plummeted to $20 level, right? Is it a good time to invest in crude oil? I mean, that was the discussion in my 카톡방 among my friends, right? Today, right now, some of them are right experienced investors and a big fish, and they say whenever my kind of guys, right, or you and me, right, average people, pay attention to anything like this, it's already late, okay? The chances are gone. And they say enough of a, demand was there already, so that the opportunity has gone. You should have bought it when the price was below 20. So many buy orders are there at the $20 range already. So forget it, okay? Rather, maybe you will be interested in crude oil, ETF kind of things later on. All right. Good. Now, getting back to the stock market data, okay? As I have promised you before, okay? Let's get back to the stock, each stock. I am interested in those stocks, please. Well, what is your favorite company name? I know it, Tesla. Okay, why? Because I said it. Okay, no other reasons. Anyway, Tesla, no. I have to search for company ticker symbol over here. Give me Tesla, TSLA. So you have to click this ticker symbol or 종목 코드 in Korean terminology. Tesla Incorporated, the stock is down 2.23% today. And as of the moment of that I'm recording this, right, this is what? April 2nd, right? This is the price, 472. If we expand this data, the price chart to 1 year, right, then it used to be around what? $900, and this is about half the price. If you invested at this time, you're screwed. Okay? If you invested in this stock, I don't know, somewhere in this period, 427, the bottom, okay? Maybe you made some money, okay? But this is generally, right, after the peak, right? Would it return to this peak level? I don't know. Maybe not, okay? But let's see. I cannot guarantee. Right? If I can guarantee or anything, right? Why should I be working as a professor in the first place? I should have been in the Wall Street. Right? Nah, I'm not good. I'm not there. So anyway, so that's that. And then you see the price changes every second like this. It is heavily traded. Why? Because everybody knows Tesla and they're interested in this company. And then where is beta? Okay, where is the beta? The first chart is about the summary. Okay, summary about this company. You see previous close, which is the stock price the closing stock price of Tesla yesterday. Okay, yesterday, 481. Okay, so now it is 2.9% down compared to yesterday's closing price. And opening price is today's opening price as of the moment of beginning, okay, of the session, trading session. Bid price and ask price, what is that about? Well, there are some traders who are brokers, right? Brokers or dealers who trade this stock as a middleman, okay, who searches for buyers and sellers of this stock and matches those buyers and sellers. This middleman needs to get paid somehow by working as a middleman. This is a building block of the OLS regressions, right? And it started with the stars. Starry, starry night. Paint your palette blue and gray. Valued, right? Let's say this is true. Then over time, what should happen? Undervalued, many people will say buy, 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 recommendation. So the demand for ExxonMobil will go up. The price will go up, and then the expected return go down because there's inverse relation going up. So expected return will go down, 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 converge to required rate of return on the security market line. Make sense?